Emerging managers really need to understand the role of what their LP base is and have the understanding if they're here just for fund one or fund two, or if they're here for the long term.
On this week's episode, we welcome back to the tank Jamie Rhode, now a partner at Screendoor, to discuss all things emerging managers and LP investing. Jamie shares her reasons for joining Screendoor as a partner and what drew her to working with that amazing team over there, and how the venture landscape has evolved since leaving the family office world. We discuss how LP perspectives are changing regarding emerging managers and the challenges they face with investing in the asset class when compared to the public markets. We dig into the different ways that Screendoor sources emerging venture funds and how they support their portfolio of GPs in different economic conditions. Lastly, Jamie shares her advice to emerging managers looking to make a significant impact on the VC industry at the current time when so many are contemplating leaving the industry altogether. Thanks for joining us in the tank for the second time, Jamie.
I'm so excited to be here. Same love for early stage venture, just different perspectives, different jersey.
Exactly. I appreciate you taking the time to join us again. It's obviously in a different role, as you said, this time as a partner at Screendoor. But for some of our listeners who may have missed our first episode back earlier this year, it would be good if you can give us a brief background on how you ended up in the investment industry, your roles at Verdis, and your decision to focus on emerging managers as an asset class in venture capital.
Yeah, so I started my career off at Bloomberg, the data company, not the family office. Always have to put that out there. I think being there really grounded me in leveraging data to kind of guide my decision-making process throughout my career. While I was there, I was on the data analytics and equity research side, realized I really enjoyed writing and spurring my intellectual curiosity and kind of digging deep into things, but was like, a computer's going to take my job, so I need to find something else to do. Found my way into family office world purely out of luck through the CFA website. Being at a single family office, having a multi-asset class perspective, I think really gave me an edge in the venture capital ecosystem, having managed a public markets portfolio, looking at buyout, and then looking at early stage venture. You could see the different returns and the opportunity costs associated with putting $1 to work in venture versus the S&P versus a buyout fund or even real estate and oil and gas. But I started to realize over time, I really had a love for early stage venture, particularly emerging managers. I think it kind of hit the part of my personality that loves the build mode and, digging in deep, doing that research, trying to find some type of edge or trying to find, the underdog in the ecosystem while also having to have patience, which is absolutely a weakness of mine. Such long feedback loops. But I recognized early stage venture, particularly emerging managers, really offers unique return profiles that I couldn't find in any of the other asset classes that I was helping manage or had exposure to. And so I started to realize emerging manager was the place for me.
Jamie, you and I have had so many conversations about that underdog versus sort of uniqueness story of an emerging manager, but also that point you said about how you will not know you are good at this job for a very long time. You'll know if you're bad pretty quickly, but you will not know if you're good for a very long time. And I tell my team that all the time. It's like that J curve really has a psychological impact on a lot of people, especially in the recent years of the ups and downs of the bumpy road we've seen for emerging managers. But you made a move, obviously, over the last year. There was a lot of speculation when you left Verdis to join an amazing firm at Screendoor as partner. Can you talk us a little bit about the reasonings for joining Screendoor and what drew you to the amazing team over there?
During my time at the family office, I started to recognize that there was a lot of friction and complexity in emerging manager land, but a huge opportunity set, especially for allocators that had a long duration focus. And so I really wanted to take the next step in my career to not only help the emerging manager space and create a lot of more standardization that would not only allow access for more LPs, but allow more managers to flourish where their superpower is investing. And I'm sure we'll get into this, but going from an investor to a fund manager is really, really challenging. And so is there a way that I can not only help LPs produce early stage venture like returns, but also access this part of the ecosystem while giving back to the emerging manager community? At the same time, I would give advice to emerging managers about, okay, so now you're approaching fund 3 or fund 4. How have you evolved your network and your access reach to stay relevant to where the winners could be emerging from today? So I always say that the winners emerge from the edges or the tails of early stage venture. So you need to stay relevant in those tails. And so I started to realize I have a great emerging manager network. I've backed a ton of funds. I get referrals from those managers, but is there a part of my network that I'm not pushing my limit on? Am I starting to stay focused in an area where others are thinking similar to me? And I want to avoid groupthink, because that is the way to truly produce venture-like outcomes, is having a diverse perspective and constantly evolving your network. And when the Screendoor opportunity came my way, getting access to now 14 GP advisors that were emerging managers that have now emerged. And a couple of them I've known for a very long time, having relationships with them. But a lot of those 14 GP advisors I didn't know. And so those advisors would give me access to a whole new pool of emerging managers that I potentially had no access to from day zero. And then I'd say additionally, my partner, Lane Johnson, who has relationships with a lot of the brand name firms, she has that access play around, spin outs, where I was getting some spin outs, but it wasn't necessarily at the day zero mark. It was more later in their fundraise after someone had spoken to them and they were sending it to me.
I know what Screendoor is, but maybe for some of our listeners, can you explain the evolution of Screendoor and those advisor established managers who were emerging in the beginning, and what Screendoor's purpose is in the market today?
Yeah, so Screendoor was started in 2021 by Satya and Hunter at Homebrew. They recruited 8 other GPs in the ecosystem that essentially were emerging managers, but now have emerged. So think Charles Hudson at Precursor, think Eva at Vika, think Kirsten Green at Forerunner, or Aileen Lee at Cowboy Ventures, and said, I think that there's a place in the market for basically an emerging manager focused fund of funds to go back first institutional funds, because we have a lot of managers come to us asking for help, asking for capital. And on an individual basis, they can only write tiny checks into a handful of managers. But could they turn that tiny little access play and help into something significantly greater than that? And so they went and raised institutional capital and started investing in first institutional funds. And I would say once they realized they had product market fit for a vehicle like this, they realized they needed to hire a full-time team to execute on it, given they were running it on nights and weekends, which works in the beginning. But when you start to realize what goes into investing in 15 to 20 fund managers and managing that out over the long term, you need a full-time team that's done it before. And so they hired my friend Lisa Cawley, who I had met in family office world and in venture world about a year and a half ago, to start building out the operations of the firm. And then she hired Lane and I earlier this year to really manage the investment side of the house. And the way Screendoor has evolved is that it's the 3 of us running the platform full time. And with the hiring of Lane and I, we are in the process of expanding that mandate to not only invest in Fund 1s, but to invest in Fund 2 and beyonds, because Screendoor's purpose in this ecosystem is to be the go-to premier cataclysmic anchor style investor in emerging managers. We want to help you go from that investor to fund manager as we pair each of our portfolio GPs with 2 of our 14 GP advisors. So you're not only getting capital, you're getting counsel from those GP advisors to the life of your fund. And I would say that our vision here is for our LPs to either take our future allocations, because we're not going to back you through Fund 10. We're here for your emerging manager part of the journey, or to have those LPs double down alongside of us. I think that's a challenge in venture, the lack of transparency, and we're here to fix that.
Underdog story meeting underdog story, backing underdog story, right? You got the homebrew startup idea that ends up becoming extremely successful and now running their own capital with all the other emerging managers, like you mentioned, from Cowboy and Fika to going in and Charles supporting the next batch of emerging managers, and then bringing in a new group of LPs that also want to back the next generation of emerging. You should have just called it, Ripple Ventures or something, because that ripple effect just continues happening every time you guys bring on new partners. But let's talk about the evolution of Screendoor, because, the venture capital landscape has evolved tremendously since when you and I both started in the business to where we sit today. And Screendoor, as you mentioned, is building this fund of funds platform that wants to endure through all market cycles. Given how crazy the last few years have been, what are you seeing for emerging managers out there, especially in the last year or so, when it comes to actually getting out of that emerging manager bucket and becoming an established manager?
Going from investor to fund manager is a huge outstanding question of how do you go about doing it? And I think the first question that an LP needs to ask, and something we ask, is, are you building a fund or are you building a firm? Because there's situations, and depending on the type of LP you are, it could make sense to go back this manager for 1 or 2 times because you are, the 5th employee at some top firm that just hit $5 billion in valuation, and you have access to a bunch of great employees that are leaving and spinning out and starting companies. So you're going to go raise $10 to $15 million and go invest in all the top employees that are leaving this company. That's great for right now. That's probably not great for 5 funds unless you evolve and adapt and kind of build out your network. So I think that's a core piece that something we ask at Screendoor is, are you building an enduring firm? Are you building a firm that's going to evolve and last through market cycles? Especially because you've seen in the bull market of venture, when it's a bull market and everyone's getting capital, everyone looks good. And you see this a lot in public markets because the feedback loops are a lot shorter. You're getting daily marks, where in private markets, we talked about this earlier, it's such long feedback loops that you can look really good with paper markups. So I think for the emerging manager space, it's really important to have the framework and the mindset to how it really is based on going from investor to fund manager to get institutional capital in the future, to kind of get those types of LPs that are going to re-up with you and back you over time. And it's okay if you don't know how to do that, but you need to surround yourself with a network that knows how to do that. So I think a really, really important question is, do you know what your unknowns are? And are you honest about that with LPs? And do you seek guidance and help on how to fill that void?
The hard thing for emerging managers, as an emerging manager myself, who is building a investment platform rather than just a fund, has always been this sort of the grass is always greener conversation around how some funds are, yes, getting those crazy NFT-like markups and getting, follow-on funding, but underneath the hood, there's really nothing potentially there or structurally there to build an enduring franchise. And so it's like, you're saying one thing as an LP to that manager, but then you're doing another thing. It's very hard. So maybe you can break it down for our listeners. What does it mean to build an enduring franchise as an emerging manager? Walk us through the allocation of time and resources of where it should be dedicated beyond just the obviously finding great investment opportunities.
It's all manager dependent. And I think a huge thing that we look for at Screendoor is managers that have unique life experiences, networks, and expertise that allow them to have an incredible advantage in picking and winning the next generation of founders. But when you talk to fund ones or even fund twos, and say it's a solo GP or an extremely lean team, and they've had a couple years of investing, and you ask them, how much time do you dedicate just to investing? I feel like the answer, at least I've been hearing a lot lately, is less than 50%. And in those situations, it's because there's a lot of operational complexity. There's a lot of fund management that goes into it, especially if you have institutional LPs and you have an audited financials fund. As taxable LPs, the timing of your tax reporting is really, really important. If all of your LPs are non-taxable, that's a much easier lift for you. But knowing that you could hire a fractional CFO to help manage that back office piece if the fund size allows it or if your personal situation allows it, can really set you up for an advantage and an edge to spend more time investing. Also, making sure you have an investment and decision framework that guides you through all market cycles is highly, highly important. I think it's really easy to get into FOMO investing, and this is really hot now, and I need access to AI and no more crypto, but you need to stay focused on long-term success. And we talked about this earlier, the long feedback loops of venture, you really have no idea right now if it's successful or not. And so having guidelines and decision frameworks that keep you grounded in venture and using data to guide that process, whether it's understanding what the base rate is in the ecosystem that you're investing in, what the potential outlier valuation would be, what the potential probability of an outlier is, and then creating a portfolio construction strategy that matches that is really, really important and can help guide you through market cycles because things change so rapidly.
Yeah, I mean, speaking of portfolio construction sort of examples, you and I have talked about this before, but maybe you can give our listeners some insights on setting a fund target and that minimum viable fund size criteria, because right now a lot of people are obviously not hitting their initial fund size targets, and maybe they should be taking some lessons from what you've seen out there being done by setting that minimum viable fund size framework.
Yeah, I think this is a great question. And this is typically what I ask fund managers, especially ones that are raising smaller vehicles. For me, I want to understand what is the fund size that makes your strategy work, allows you to cover your bills. I mean, if you have audited financials, LPs pay for them, but it does come out of the fund AUM. And you need to be cognizant of, if you raise a $10 million fund and you take all that $10 million and you deploy it into investments, that's great, but do you have enough to cover, the cost of running the business and the cost of audited financials? Maybe not, unless you get really lucky and have some early recycling. For me, the way I think about minimum fund size is you can have a target, but let's talk about what below the target is, what allows you to make that strategy work and prove it out. I've seen a lot of fund managers that, let's make up a number, have a $20 million target. And the first 6 months, it's relatively easy to get to 10 million. And then the second half of the fundraise takes 18 months, some insane amount. And then they have to make this decision. Do I start investing? What check size do I write? Because if I'm a $10 million fund or a $20 million fund, it's probably two different check sizes. And then how long do I choose to keep going? And so for me, I'm always like, what's that minimum viable fund size? Are you close to it at your first close? Are you okay if you put a line in the sand and say, okay, I hit 10 million in the first 6 months. I'm going to fundraise for another 4 months. And if I have traction and enough that I feel like I'm going to get to that 20 million soon, I'm going to keep going. And if it's really hard and it's not working, just close it out at 10 million, invest it, and then probably 2 years from now, you'll come back with a track record of access, at least, maybe not markups, but a track record of access and proof that you can do what you said you were going to do, and then come out and raise that $20 million fund, or maybe you can get to 30 based off of the $10 million that you deployed. So I think minimum viable fund size is very situational dependent on the type of strategy that you want to deploy. But I think you have to think about that and communicate it out to LPs before you even go out and fundraise.
Yeah, I mean, as a fund manager, has had to go through this exercise of chicken and egg as well, knowing when to deploy and how to deploy while still raising capital. I think the best advice I was given that I give other emerging managers is just get started. You have to start planting those seeds in the ground, because most emerging managers, as you and I both agree, are investing at the earliest stages where they can get the most amount of ownership with the least amount of capital. But those investments take a lot of time to show proof points and traction for you to go out and raise the next potential fund. The other thing too is, because early stage startups are changing so rapidly. I mean, we have companies that are changing month over month, week over week in terms of their performance, that maybe you'll get that follow-on investment and that markup that you're hoping for faster if you just get that first check in instead of waiting 6 months before you get that full fundraise together. Because you may miss that next big opportunity, as you said, if you just wait to get that $20 million target. What does that even mean, really? It's really about taking capital and making the most out of that initial capital, but having that minimum viable fund size around all the parameters regarding your management fees, your audit cost, your legal cost, your structural infrastructure cost, all those things is very important. So what we do is we just have a budget. We actually create a full operating budget for the management company and all the costs associated with it, all the way down to our Slack user licenses, so that we know what is enough to actually fund the operations of the team and the management company, so that we can actually have a minimum viable fund size to then go and invest off of. And then obviously there's recycling, as you mentioned, which is important. But then there's also, taking less management fees in the back half, right? You can maybe say, okay, maybe we'll take management fees for the first 3 or 5 years, and then nothing in the remaining 5. Well, therefore, you have more capital to deploy up front if you don't need to spread it out over that 10-year period, would you say?
Exactly. Yeah. And I think creating that fund model, creating that fund budget, and showing LPs that you've thought about this, even if you haven't begun executing on it, is a way to show that you have a mindset and a framework that I am maybe an investor today, but I'm going to become a fund manager tomorrow.
Yeah. And speaking of minimum fund sizes, let's also talk about minimum check sizes when it comes to accepting LPs. How should you think about this, or how should an emerging manager think about this when they're struggling to get to that $20 million target? They're stuck at 10, but they also want to keep within the regulatory structure of how many investors they can have. while maybe reducing their minimum check size to let LPs into the fund?
I think that when you're struggling to raise, or even when you're not, but you have check sizes that are smaller than ideally for you, I actually think it's more around who is that LP and are they going to be accretive to you? Because at the end of the day, investing in a venture fund is a marriage. It's likely 15 years, even though it's 10 plus 2 typically, but I've seen in this market a lot longer than that. It's a marriage. So if these smaller checks are going to be helpful to you in terms of, I need to take these 25 smaller checks to at least get me to maybe my minimum viable fund size, or get me to a first close to show some of the other LPs that won't come in until it's a second close, I think that can make sense as long as they're going to be helpful and accretive. Maybe some of them are going to help you with deal flow, or they'll help you with an underwrite. They could be resources for you. I think there's definitely operational challenges with having way too many LPs, especially if they're small checks. You're sending capital calls out that if some of them missed or haven't seen, you're going to go chasing after them. And so I think there's a balance there, but I've seen a lot of fund managers start with a lot more smaller checks in the beginning from LPs and then concentrate that over time. So I think if you start off with a lot of small checks, realize that that's probably temporary and that you should be already fundraising for your next fund, seeking out those larger checks. And so I think there's some friction and balance there that's needed, but I wouldn't say no to taking small checks as long as they're helpful.
What I tell emerging managers is have a certain allocation of small checks. So you have, like, let's say 100 investors, let's say in the fund, or 99, whatever. You want to have 20 in the small check category. And the smallest you can accept is like 50K or 100K or whatever it is. But once you've used up all those small checks, you can't have any more. And that's why the strategic value those LPs bring is really important as you get down to the last 5 or 10. Just taking off your Screendoor hat for a second and putting your family office hat back on, what emerging manager trends are you seeing among the family office crowd, where a lot of people are tending to try and source capital from, as maybe the institutions have slowed their pace towards emerging managers as of late?
This is an area where it's vital for emerging managers. I mean, family offices tend to be, or high net worth individuals tend to be, the most frequent LPs that I find investing in emerging managers. Call it fund ones and fund twos, typically because the fund sizes are so small that institutional allocators that need to write $50 million checks just can't even think about this space, especially given, I think the average fund size for an emerging manager is around 42 million. And so I think that emerging managers are vital to family offices, especially because early stage venture offers unique returns and emerging managers really can provide the access to those first institutional checks. And that allows family offices, or even any LP, to compound their capital at extremely high rates for long periods of time. I mean, if you look at the Cambridge data from 2022, it shows that the 25-year CAGR for VC is at 28%, buyout is a 14%, and public markets is an 8%. If you think about a CAGR of 28%, the last 20% of time produces 50% of your return. So over 12 years, if you can capture a 25% CAGR over 12 years by investing in early stage venture, particularly emerging managers, that turns into about a 19x, while buyouts almost a 5 and public markets is a 2.5. But if we stop that at that 80% of time mark, or the 9 and change, it's only 10.7 for venture, 3.5 for buyout, and 2 for public markets. So I think that emerging managers are vital to the asset allocation for family offices. But I think the challenge that family offices have is not necessarily access in terms of check size to get into those funds, it's finding them. There's been 4,000 emerging managers since 2015. And if your top of funnel is not representative of the population of emerging managers, you could be investing in a pool of funds that have adverse selection, and you're missing the new networks, the new edges that are forming in venture capital. So I think if family offices have a dedicated professional to this part of the ecosystem, then I think that they have the network and the access to go ahead and build out a portfolio themselves. But if not, that's where the challenge comes, because if you're wrong in venture, you're likely getting the median return, and that's not very attractive.
That's a great idea. I mean, we have a lot of family office LPs in our funds, and we actually introduced them to fund of funds who've been investing in venture for 25 plus years, just to learn about the landscape and also get caught up on what's changing and where they're seeing a lot of their deal flow. So I think that's a great way for also family offices to get exposure in the early days of learning about the asset classes through that fund to fund platform model. Speaking of which, how does Screendoor source emerging venture funds? And what's your sort of secrets to getting into those up and coming emerging buckets of spinoffs or something?
I'd say that, myself and also Lisa have been deeply ingrained in the emerging manager ecosystem. Just like you said, you send funds to your LPs, you may send them to fund of funds, but at the same time, a lot of my emerging managers that I've backed in the past send me funds that their friends are starting, or so-and-so is starting just from a startup that I invested in before, and now they're turning into a fund manager. Or actually, some of the best fund managers I've seen have come from GPs I've passed on just because I've disagreed with maybe their portfolio construction or, the sector and or the geography that they're investing in. But I've made it abundantly clear. And that's also our goal here at Screendoor, is to be transparent and get feedback about if we're passing on you why. And then what gets returned there is those GPs that we passed on can send us fund managers that fit more of our mandate. I'd also say the other piece, and I mentioned earlier, is, Lane Johnson, coming from Texas Teachers and Goldman, has networks within the more established players. And so that's helpful from sourcing spinouts on top of having 14 GP advisors that started Screendoor because they were getting so much inbound from emerging managers asking for help. And now they just funnel all those to us. The three of us vet them out and they'll get pulled into the process later on, but they have to get through the three of us first. And sometimes that could be as simple as we had an intro call. I really like them. Let me do a gut check with the 14 GP advisors. Or, you know what? I've done a couple intro calls. There's some gray areas. Let me have this prospective GP go meet with one of our GP advisors for an hour and talk through anything that's outstanding, whether it's around, do I want to be a solo GP? Do I want to be a partnership? Do I want to raise 100 million? Do I want to raise 50 million? How do I handle back office? How do I handle operations? What types of LPs do I want? Screendoor really can offer a unique value add to a lot of emerging managers.
This spin out concept is so interesting for a lot of people, but it's not foreign to me at all. I mean, coming from the hedge fund world, you had this in the hedge fund industry forever. You had the Tiger Cubs, you had the SAC Capital, Steve Cohen, before he changed to a family office spinouts. You had D. Shaw, you had Millennium. There were so many portfolio managers that were spinning out of the big brand name hedge funds back in like the early 2000s and starting up their own shops, but they were relying on these back offices and these infrastructure teams, these sort of fractional management company funds, to help them with not just sourcing capital, but also managing the infrastructure of the fund early on before they can stand on their own 2 feet. And it's great to see that there's the venture capital industry taking hold of that sort of strategy as well. But there still is a lot of fragmentation across the landscape, especially at the seed stage of investment. So how are you thinking about that fragmentation? Are you seeing it consolidate given some of the tourist VC capital we saw come out in 2021 and stuff and receding back to like the diehards? Or is there still a lot of fragmentation in this industry?
There's a lot of fragmentation in this industry, and there unfortunately or fortunately will always be fragmentation. I mean, this goes back to being data driven, and I try my best to be grounded in the base rate of the market. And the probability of success in seed stage is very, very low. Only 2% of startups turn into an outlier, but those outliers make up for all the losses and drive that mean return to be highly attractive. It's why venture capital is called a power law distribution. When you look at a lot of the research out there, you can see only 2 venture funds have invested in more than 3% of the outliers. 30 seed funds have invested in 1% of the outliers. So that's validation to me that there isn't some super secret pool of startups that if you only invest in brand name fund X, you can get access to. It shows me that I need to be investing as an LP in a broad range of funds to increase my chance of capturing the small subset of extreme winners that drive the mean return. It's typically why you see fund of funds and venture capital have the ability to perform well. They offer a diversified pool across vintage years in a highly skewed asset class. But the alternative is an LP investing in only a few funds. That would mean they have a high probability of earning the median return, which isn't influenced at all by those big winners. It makes building out a diversified pool of managers a highly attractive way to harness the power law-like returns and ensure that that fragmentation is being captured within your overall portfolio.
One thing I would ask, for you to opine on is sort of the demand or the necessity for capital to be absorbed by startups these days, especially with productivity gains with AI and the ability to build more with less. Do you think there's even enough demand for early stage sort of seed capital from the startups that are asking for it before they end up choosing their own path, whether they can become profitable and never need capital again, choose a majority investment from a large private equity firm or a strategic like NVIDIA, where there's even room for a lot of seed stage funds to deploy that capital still?
Innovation breeds opportunity, but I think that that opportunity is very fluid and has different demands. So I've always felt that pre-seed and seed, or funds that write the first institutional check into a startup, are capacity constrained. Now, in certain markets, maybe a couple of years ago, the capacity increased a little too much, but it was greater. But now that you're having a different venture funding market, that the capacity has gone down. So I think that's why you've seen a lot of studies out there that show small funds outperform. But I actually think it's because if you're a small fund manager, you have the capabilities to deploy all of that into pre-seed and seed, or into that earliest stages of a startup's life. So I think that sometimes in certain market environments, if you have a $100 million fund, it actually may be really, really hard to deploy all of that pre-Series A. In other markets, it may make a whole lot more sense when seed rounds increase. I always stay focused on finding fund managers that are grounded in first check investing and are cognizant of the market and keep their fund sizes well within the strategy that they're trying to deploy.
I mean, we're a pre-seed focused fund only right now, and our check sizes between 500 to $1 million are leading rounds, and they're being filled with strategics or angels or high net worth, whatever. And they're not needing capital for several years, where they can potentially skip the seed round and go straight to an A with the traction they're getting, and the capital they're burning is way less than what their revenue is at the time they're going up for next round of investment, which is incredible. It's something we haven't seen since, probably pre-2018. So I guess my question that I'm wondering is is there enough great companies? Yes, there's going to be a lot of companies that give you opportunity to invest, but there are enough great companies for even a seed plus or early Series A fund to deploy, or are those companies going to just pick the top Sequoias and Andreessens every time because they're the top performing ones and they're just going to blow through everything else because they haven't raised a lot of capital as well? That's what we're seeing. And it's an interesting problem, but I'm just curious what your thoughts are.
It's funny. Part of your question validates the seed stage is going to remain fragmented if less funds can get access to the pool of startups. I think that syndication will always exist. Let's call it a pre-seed and seed and maybe even some Series A. So I think there is multiple ways to access those startups, but I think there's always demand for access to innovation. Early stage venture offers such unique returns. You can't find in other asset classes. So there's a reason to have it in the asset allocation. But when startups need less capital to make it to later rounds, that's going to weed out, I'd say, the venture fund managers that are just doing this for fun, or are just doing this because I'm just an investor, not a fund manager. And I think that's what you're starting to see in this ecosystem. I'd also say that different sectors lead to different types of funding needs and outcomes. So it could potentially be a few sectors. You skip the seed round and now it's, a pre-seed and a Series A, where others are, you don't do a pre-seed because you have a bunch of repeat successful founders, or it could be that you have grants or government funding that kind of start you up first, and then you take your first round of capital. So I think the right way to ask that question as an LP is, can I find fund managers investing in that first institutional round? And it could end up being that this GP does pre-seed and the follow-on is A because seed doesn't exist, or someone is a seed and they follow on is the Series A. And so I definitely say markets are adaptable and fluid, but that's the best part about getting to invest in a ton of fund managers, is getting the boots on the ground kind of gossip, I would say, from someone like you or someone from, other managers that I chat with all the time telling me market dynamics are changing.
The way that we explain it to LPs is founder fund alignment. When our check size and our fund size and our strategy matches perfectly with what the founders are looking for from a capital invested, from the traction they need to get to the next round and choices they have beyond that, is what we like to find when investing in companies. Obviously, if a company needs to raise, 50 million for their seed round, we're not going to be a part of that round because it makes no sense for our fund strategy. And that founder is probably not aligned with our fund strategy as well. So, I like that concept. But talk about how Screendoor, is supporting portfolio GPs right now in this fluid economic situation we have here with the capital markets and individual investments.
For us, having the 14 GP advisors, 2 of them are paired with each of our underlying portfolio GPs. And this can be help in various ways. It could be through, this is advice on capital raising. This is advice on fundraising. This is advice on how to institutionalize your venture fund in terms of operations, in terms of investor reporting, in terms of fundraising. And, this is the type of LP that might give you a headache, and you should ask these types of questions because it's not just a one-way street. LPs should not just be asking GPs questions. GPs should be asking LP questions and make sure the marriages fit on both sides. I'd say we also have our GP advisors help with founder pay-to-play situations. I think a great example is a fund manager that we did due diligence on earlier this year, where they were stuck around, do I want to raise a venture fund and find a partner, or do I want to go the solo GP route and then at a fund 2 bring on a partner? So we had that venture fund manager meet with one of our GP advisors that's done both. He is a solo GP today, but prior to that, he was in a dual partnership. And then prior to that, solo GP. And so there's a lot of challenges that go about starting as a solo GP and bringing on a partner in the future. And so we leverage our GP advisors to just augment that prospective GP's thinking. It's a way to share outside the box ideas that are rooted in experience and just help them think through challenges over the next 5 to 10 years that maybe they haven't thought about today. We're really here to kind of help you and be that sounding board where I think all of these GPs would be successful on their own. We're just here as a resource to add what I would also call free leverage to your opportunity set. And so having the diverse perspectives of those 14 GP advisors and to tap into one of them and saying, hey, I've dealt with this before, or this is my experience in these types of situations, this is how I would handle it, is super, super helpful. And I think, keeps us flexible and adaptable to handle anything that comes our way.
Yeah, absolutely. One thing I would also love to hear from, the team at Screendoor one day is how to do investors that are just a pain in the ass towards the founders. And you're the sort of founder friendly, but also like constructive, supportive one that also is trying to get that other investor off the founder's back to deliver some type of return while just nagging them for all these constant reports and things. That would be an interesting one to get a GP's perspective on, because it's a small community and you have to work with some of these on another file later on, and you want to have that relationship with them, but you also want to fix the problem that you have in front of you. And so sometimes I find it very difficult, and then it could burn a bridge also when a founder wants to go and pitch that investor for another round. You're like, look, I'm happy for you to go pitch them, but I didn't have a really great experience with that investor last on the board. Do you want to make that founder aware of that or not?
I love that, and definitely plan to incorporate that feedback and question into what we're building here. I would say that I always question how much skill and luck goes into picking winners at the early stage and how much a VC can truly influence, let's say, a positive outcome for a startup. But I think that a VC can absolutely influence a negative outcome for a startup. I think bad advice exists a lot in this ecosystem, and a brand could potentially have a positive reputation, but an individual has the potential to provide bad advice. And if a founder takes it, I think there's a higher probability of failure given taking bad advice versus taking good advice. And I'm not sure if that truly leads to $1 billion outcome.
Look, when things are going and people are trying to fight for their own share of the pie, obviously things are a good outcome. So people obviously want as much as they can. But when things are a bad outcome and you're just trying to save whatever you can and bring parties together and they're adding more fuel to the fire, I think that's someone's true colors, and we want to make founders aware of that. Because as you said, it's a very long journey. It's 10 plus years sometimes. So you want to know who you're getting in bed with on the LP side as well as on the GP side. So obviously, Screendoor has got a lot of experience with that with all the other established managers as advisors there. I want to talk a little bit about the role that LP play in supporting emerging managers from the direct side that Screendoor brings to the table.
I think that, when I think about the LPs that we work with, I think there's two flavors of LPs. It's one that can do emerging managers themselves, but do not have the bandwidth or team to fully have the top of funnel access that's representative of all the emerging managers out there. So, we work with LPs, and that helps give them exposure to a curated basket of emerging managers, and then they can go double down on them, or they can go invest in their next fund. I think you have another basket of LPs that I see in the market that can't even think about emerging managers because of fund size, because of operational complexity, because of legal requirements, because of track record requirements, a bunch of headaches that don't even allow them to take one look at this market. But if you wait until they're a fund 3 or a fund 4, you might not get access. There's a lot of managers that I've seen out there, especially in this market environment, that are either decreasing their fund size or maybe increasing it 5 to 10%. So then that also turns into a challenge for emerging managers. I may have a $35 million fund. That's my steady state fund for the next 3 to 4 funds. But my fund 1 and fund 2 LPs were here just for the beginning days, and I need to go find new LPs for fund 3 or fund 4. Emerging managers really need to understand the role of what their LP base is and have the understanding if they're here just for fund 1 or fund 2, or if they're here for the long term. And some LPs are purely just capital. Some LPs are using you just to get access to your co-investments and directs. And some, may be there because they want to help you institutionalize your fund, or they're like a Screendoor and providing capital and counsel. But I think it's a mixed bag, and it's on the GP to ask the LP, what is the purpose of your venture allocation? And, what do I need to do to make sure that you back me for the next 3 to 4 funds, or have a full understanding if you're only here for just the ride of the next 10, 12 years?
What are your thoughts regarding that GP LP fund fit of having multiple pitch decks for the different kind of LPs you're pitching? So you got the family office, access to your network or co-invest. You've got corporates who want access to the portfolio companies updates. Endowments who want access to, underrepresented work you're doing or whatever. And then you have also, the traditional fund of funds who also want direct co-investments through pro rata. What are your thoughts on having multiple pitch decks to tell each story a little different?
For me and my personal experience, at the end of the day, a lot of this is education to the LP. So getting an understanding of this LP has been investing in venture for 10 years. They've done 25 emerging managers. They know the space very well. Don't waste your time on educating them around venture and emerging managers. Focus on exactly what you're doing. But if you're meeting with an LP that is brand new to the sector, or, hasn't done emerging managers before, you need to provide a lot more background and education. And at the end of the day, all these LPs have to go home and write a fund memo and present it to their principal or to their IC or to their board. And so if you can provide them with materials that will help that process go smoother, then absolutely do that, because that means there's a higher probability that they could be investing in you, because you provided the education not only around the benefit of why they should pick you, but why they should be doing venture in general.
Yeah, totally for you. What about crossover with another competing or similar strategy fund that already exists in that LP's portfolio? What are your thoughts on sort of calling that out ahead of time and explaining why you're different when you know that they've invested in that counterpart of yours, instead of waiting for them to come back and saying, sorry, we have too much seed exposure in these 5 or 6 GPs already, therefore we can't slide you in. What are your thoughts on that?
Yeah, I think that is very, very important, because for me, and the way we think about it at Screendoor, is every manager that's added to the portfolio needs to be accretive. So I'm looking for unique access. And if there is historical portfolio overlap, I want to understand why, and is this going to happen again? Was this a one-off scenario? Did that other fund start to change their strategy and maybe 2x their fund size? So you're accessing the same companies in the round before, and maybe I should go with you over them. And so I think calling it out as early as possible makes sense, because in fundraising, getting to a quick no is going to help you because you'll spend less time on that LP and hopefully more time on another LP. That could be worth your time and commit to your fund.
Thank you for answering those questions. Okay, lastly, before we jump into our fast favorites, what advice would you give to emerging managers looking to make a significant impact in the venture capital industry at this current time with so many changes happening and some people even contemplating leaving the industry?
That remaining humble and kind throughout the whole experience goes a very, very long way. I think you need to reflect enough on yourself and your life experiences to know what your known unknowns are and be very transparent. Be very transparent with LPs, also be very transparent with founders, and then take the feedback that you're getting from both sides of those aisles and say, does this still make sense for me? What is my why? And is my why to LPs and my why to founders the exact same? Or are they two different things? Because if it's two different things, I'm going to start questioning your actual why and if you figured it out. I think being thoughtful about how you're going to fill those holes in the future is highly important too. And if you are actually building something that is reflective of your past life experiences, your past career, and is that giving you the right to be the best, the founder magnet around sourcing, selecting, and winning. And if that's a yes, then go ahead and endure because anything that's worthwhile is not going to be easy.
Those are great suggestions. Being humble, being thoughtful, being consistent, and being transparent are all core things for sure that an emerging manager should always remember when speaking with both founders and LPs. So thank you for sharing that, Jamie. All right, let's see if your fast favorites have changed since the last time we spoke. So first off, your favorite podcast.
On the personal side, I love Tiesto, so I listen to his podcast every week. It's great for the gym, by the way.
What is it? I love Tiesto too. I didn't know there was a podcast.
He does a weekly podcast drop on Fridays, and it's great for my Saturday workout at the gym. So I'd say from a business side of it, I have to call it the last podcast I was on, the 10X Capital podcast.
Nice. All right. Next is your favorite newsletter or blog.
Embracing Emergence by Benedict Langer. He had me as a guest on there, and it really aligns with my style and thinking.
I love it too. He's supposed to be coming on this podcast soon. We're just waiting to lock in a date. So push him if you can for us, Jamie.
I will.
Next is your favorite tech gadget.
Okay, so this one's kind of funny, but now that I took this role at Screen, I was new desk setup, new everything, and I got a walking pad for under my desk, which I'm not using right now, but it's amazing.
Is it amazing? Really? Okay, I could do it at my standing desk as well. Tell me what you love about it. Is it huge?
It's somewhat big, but it's lightweight. And I would say it wouldn't be great for a podcast recording like this or a meeting. But if I'm just doing, busy work or if I'm reading something or researching something, it's something that I can do. And I'd say device that's not attached to it, that's handheld, and I can press it to speed up or go slow.
And do you break a sweat?
I mean, you could, but I try not to because then I have to shower
Have
again.
you fallen off it?
No, I haven't, but I do have that fear. I totally have that fear.
I definitely would have that fear. Next is your favorite new trend.
The ability for me to use the audiobooks to go on walks and still be productive. I'd say this is my own personal trend. I found the benefit of taking time away from a desk and having true thinking time, but also being productive is highly, highly important to being creative and always pushing your boundaries. So leveraging audiobooks or leveraging podcasts, even if it's just music like Tiesto, has been a huge benefit to me and my creative side.
You know what? I was doing the same thing. I always take long drives on the weekends with the family, and they're usually all sleeping. So I'm always listening to an audiobook or a podcast, and I'd run through all of my for the week. So I was out of fresh content. And I ended up on the monk debates. I was just so far down a rabbit hole trying to find something to stimulate my brain on a long drive that I ended up in the monk debate. Next is your favorite book.
Unreasonable Hospitality. If anyone's seen The Bear, I'd say they've highlighted that in the first season. It really offers parallels to anyone in a services industry. This is really about, running a restaurant and how being focused on your customer and providing high quality service goes a very long way, but it offers significant parallels to anyone that's in a service industry. And the ROI of always giving back to the end customer is significant.
No, love it. Got to check that out. We're about to get started on the bears, so I'll keep that in mind. And last but not least, your favorite life lesson.
Learning this life lesson is not my favorite, but I think it's taught me to be highly adaptable and flexible to situations that arise. And it really is that you make plans and God laughs.
I love that. That's amazing. I'm going to use that next time when my plans go awry.
Exactly.
All right. Thanks for joining us in the tank again for a second time with Jamie Rhode, partner at Screendoor.
Thank you.
Hey everyone, thanks for tuning in to another episode of Tank Talks. We hope you found today's conversation as insightful as we did. If you're enjoying the show, we've got 3 quick things to ask of you. First, hit that subscribe button on your favorite podcast platform so you never miss an episode, whether that's Apple Podcasts, Spotify, Google Podcast, or YouTube. Next, follow us and stay up to date on upcoming episodes and behind-the-scenes content on social media with Twitter, LinkedIn, and Instagram. And lastly, share the love. If you found value in today's episode, share with a friend or colleague who'd benefit too. Your support helps us bring in more amazing guests and keeps the Tank Talks engine running. That's it for today. Until next time, keep disrupting and innovating.